This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
So many distractions, so many current events and sensationalist headlines trying to knock smart investors like you off kilter. What's that old saying? Never let the facts get in the way of a good story? Now that we can breathe after a bounce from the recent 12% in stocks, let's clear the air, look at the markets and economy from an unbiased and unfiltered vantage point, and see what the facts actually are. Good morning. Welcome on board another edition of our Wise Investor Group podcast. I'm Simon Hamilton, Managing Director here at the Wise Investor Group of Raymond James. It has been a relatively tumultuous few months, not surprisingly so. August through October traditionally mark the worst stretch of the year for the markets, going back almost 100 years, and this year certainly did not disappoint. Markets peaked for the year in July. We saw about a 12% pullback in the S&P 500 since that time. Actually, it was more for some of a wide swath of the market. Actually, the index held up better than the broad market readings that we tend to follow. And then we've had a bit of a bounce here so far in November. So this, again, being able to take the fire hose out of our mouths and letting the market calm down a bit has given me an opportunity to take stock, to look at the economy, to look at the markets, and really hopefully help you orient your thinking as we go into the end of the year. I read a really good quote this week from Dr. Daniel Crosby, wrote a book called The Laws of Wealth. I'm just going to read it to you. Despite the unequivocal truth that investor behavior is a better predictor of wealth creation than either fund selection or market timing, no one dreams about not panicking, making regular contributions, and maintaining a long-term focus, end quote. Isn't that true? We get so caught up in things like picking the right stock, picking the right fund, that we sometimes fail to control the biggest determinant of investor success, which is our own emotions. I've talked about this for years. I want to talk about it a little bit today. And especially given this statistic that I read this week, which was not completely surprising, but somewhat alarming to actually see the numbers. According to DataTrek Research, the S&P is up in the low teens this year. According to DataTrek Research, if we were to exclude the gains from the 8 best sessions so far this year, the index would actually be negative. Think about that for a second. All of the return this year has come from 8 trading days. And actually, the margin of error has been extremely thin. The number of up days for the index, this is as of a week ago, by the way, the number of up days for the index so far is just 11 more than the number of down days. And that's with the S&P up over 10%. I think the lesson from that is fairly clear. If you're sitting there, and most of our clients do not do this, by the way, but if you're sitting there and you're not a client and you're hopping in and out of the market, you're reacting to every headline, as salacious and sexy as it might be, chances are you may have missed a good chunk of what's going on, or maybe you've just been sitting out the year in its entirety, which, again, is not the worst thing in the world because cash is paying a lot better than it has over the last 15 years, but still, chances are you've missed out on some return. And here's the thing, I'm not going to blame you because the headlines are often scaring you out of the market. We've talked about this a lot, but there are a number of quote-unquote pundits, talking heads, that are notoriously bearish, and they tend to rear their ugly heads once in a while. I'm not going to pick too much on John Hussman, but he's kind of a perma bear who I've been following for probably 25 years at this point. Hussman thinks that stocks are priced to produce returns only a couple of percentage points over the next decade, far below the 7% inflation-adjusted long-term return that most people are used to, at least historically. And he thinks the odds of a 40 to 50% crash are quite high. Well, here's the problem. He didn't say this yesterday. He said this in 2013, the summer of 2013. So if you followed his advice, you missed a 230% gain, give or take, in the S&P 500 since that time through the end of October. Think about that for a second. And again, I'm not picking on John Hussman specifically because there are a lot of people like John Hussman out there. And by the way, he reiterated his call just recently. Okay, I think as early as or as recently as mid-October, he said something similar. Well, when he called for that in October, keep in mind that the Dow could fall to somewhere, given current levels, let's put it this way. Given current levels in the Dow would need to fall about 55% just to get back to the point where he made his initial prediction in 2013, and then it would need to fall another 50% from there to hit his current target range. So how helpful was that advice? And by the way, he was not counseling people between 2013 and 2023 to get back into the market, right? It was just a permanent call that he had in place that the market was going to drop. So this is the problem with listening to folks like this, is that they only need to be right basically once to get attention from the media. There are a ton of people. I mean, how often do you read this headline that so-and-so who called the 2008 crash or who called the 1987 crash or who called this and that, this is what they're saying today. Just because somebody got a market call right in one particular set of circumstances does not necessarily mean that they have a repeatable process to identify risks going forward. And the cost of being wrong is so tremendous for investors. Because keep in mind, we have had crashes. I mean, since 2013, we had the pandemic crash, right, where the stock market crashed about 34% in a little over a month. Last year, the S&P was down about 25% from the January highs through the October trough. So it's not like we haven't had sell-offs over the last 10 years. We absolutely have. But buy and hold patient investors, for the most part, have done just fine by hanging in there. But this doesn't mean that it's going to be a smooth path, right? I mentioned those two big drawdowns over the past 10 years. The reality is, since 1928, according to Bloomberg, the stock market has averaged a 10% correction about two-thirds of all years. Two-thirds of all years. A bear market of more than 20% once every 4 years, and a crash of 40% about every 13 years. It's been that way going back, again, to 1928. And keep in mind, most of the time that we're investing, we're in a state of drawdown. Again, according to Bloomberg, about 71% of the time since 1928, the market has been not at an all-time high, been in some sort of drawdown. About 36% of the time, it's been 10% or worse. Interestingly, only 0.1% of the time is it down 50% or worse. So if you're making a major market crash as your base case for investing, well, you've been right in the last, 100 years or so, just shy of 100 years. You've been right 0.1% of the time. Okay? But again, we're always living in some sort of drawdown phase. And I think that's really important. But what does it look like coming out of these phases? I think that's equally important. Well, if you look at kind of the scatter graph of market returns, according to the folks up at Ritzold Asset Management, if you go back to 1950, long-term average for the S&P has been about 10.7% in terms of 10-year annualized returns. That's been the average. Negative, about 3.1% of the time. Now, you remember that decade, 1999 through 2009. That was a negative decade. But more than 55% of the time, annual returns have been 10% or higher over 10 years. That's a pretty big number. So yeah, a small percentage of the time, a minute percentage of the time, I should say, the market loses money over that 10-year period. But again, if you're making that your base case, doesn't seem to be warranted. And by the way, in this current example, right, where the market's peaked in January of 2022, we're still down. I don't have the exact percentage, but I think we're down high single digits in the S&P from that time. If you look at it historically, this is according to Charlie Bolello over at Creative Planning, and you go back to 1928, same starting date, when we're in this range, a 10% or less drawdown from the highs. The average S&P return is 11% going out 12 months, 41%, these are cumulative returns, 41% going out 3 years, 79% going out 5 years, 217% going out 10 years. Again, this is Charlie Bolello data. So, again, when the market's already in a drawdown and we've already been 2 years into a, not necessarily a bear market, but a consolidation period in the stock market, to make a crash at this point and to make outright negativity and pessimism your base case, hey, I'm not saying that we're out of the woods by any stretch, but if you're willing to be somewhat patient, look out 12, 24, 60 months, odds are history says you're going to be okay. So just keep that in mind. Remember, I said at the very top that I wanted to focus on facts, not headlines, not sensationalism, not biases. That's what the facts suggest going back almost 100 years. As far as the market goes itself, just a few kind of observations that I had that you may know, you may not know, but as I mentioned, the market pulled back about 12% from the July highs through the end of October. We got a bounce the first week in November of almost 6%, pretty powerful bounce. I'm not all that interested in kind of causation. It could just be that the markets were oversold and by the way, we got to an extreme level of bearish sentiment. The percentage of bears in the American Association of Individual Investors sentiment data, the percentage of bears had risen above 50%. That was in the 96th percentile of all readings. This is as of the end of October. So it's not surprising at all that we got a bounce. Sentiment doesn't necessarily tell you a lot about the long term, but as far as short term, sentiment can tell you a lot. When everyone's fat and happy and too bullish, you often get a sell-off. Whenever anyone's overwhelmingly negative, you often get a bounce. But certainly there were some more tangible reasons why we might have bounced. Certainly Jay Powell was a little less hawkish than he has been in recent commentaries. The removal of a Treasury refunding overhang, meaning that the Treasury decided to sell a little bit less on the long end and started selling a little bit more on the short end. This helped to bring down long-term rates. The 10-year and the 30-year Treasury, I would say longer-term rates have been the biggest reason why the stocks had sold off over the past few months. So the fact that they've come down a bit here over the last week and a half to 2 weeks certainly caused a bit of a relief rally. But some of it, as I mentioned at the top, could have been just seasonal. November and December historically are two of the best months. And in fact, historically, according to FactSet, November is a positive month about 75% of the time, December over 80% of the time. No guarantee of the future, but that's what history suggests. So I actually read that there's an indicator that I've followed for a long time called the Zweig, Z-W-E-I-G, the Zweig breadth thrust, the ZBT, measures market breadth, right? In other words, how many stocks are doing well or how many stocks are doing poorly on the S&P. We got to an extreme level of negative breadth, meaning the vast majority of stocks in the S&P 500 were not doing well and were breaking down below some key technical levels. Whenever you've gotten those types of historical readings, again, going back pretty much all the way to World War II, the markets have been significantly higher over the next 12 months. So that's the Zweig breadth thrust indicator. Certainly it's just one of many indicators, but typically when you get these types of readings where the vast majority of stocks in the market are doing so poorly, generally sets up for better returns going forward. And by the way, I've talked a lot about market breadth, right? I've talked about the fact that pretty much all the return in the market has come from a handful of stocks. Well, just to put a finer point on that, the folks up at Bernstein noted it this week. If you remove the quote-unquote Magnificent Seven, right, those are those large mega cap, mostly tech-oriented stocks that dominate the S&P 500. If you remove those, the rest of the S&P through the end of October will be negative for the year. But here's what's significant. I'm not trying to bring bad news. One is that generally sets up for a better market thrust going forward, like I just said. But the other thing about it is it really skews the valuation reading on the market. In other words, if you leave those 7 in the S&P, the overall S&P is trading about 20 times earnings because just those 7 traded about 41 times earnings, according to Bernstein. You take them out, the rest of the market PE is about 15, which, quite frankly, is below where the average stock has traded for much of the last 10 years. So I'm not going to sit here and tell you that the market is cheap. But if you're looking for sort of opportunity, and we've talked a lot about this, and you look at what sectors are negative, we've talked about the fact that dividend-paying stocks have significantly underperformed non-dividend-paying stocks. And where are a lot of those dividend-paying stocks held? Healthcare sectors, energy, financials, industrials, maybe even utilities and REITs, certainly healthcare, consumer staples. Maybe I'm repeating myself, but those are where a lot of those dividend stocks are. And if you look at the fact that PEs, price to earnings ratios, are not that expensive in many of those sectors, that's where we've been shopping. Okay, so that'll be something we talk about more, but it was particularly acute towards the end of October, that kind of spread between the top names and the other 490-some names in the S&P 500. A couple other observations on the market recently that just wanted to share with you. One is that earnings growth for this quarter, I think, is better than what a lot of the headlines suggest. Now, I know the margin for error was very slim. So companies that did not report good news, either about their current quarter or their forecast going forward, were punished probably more so than I can recall. I mean, we had a few holdings that I thought their quarters were pretty solid, and they went down 10, 15%. So there was no safety net for companies in this environment. But in aggregate, out of the 85% or so of companies that have reported third quarter earnings so far, according to Strategas, it's actually the highest percentage of companies that have beat estimates in about 4 years, with a blended growth rate of almost 5.7% for the quarter. That was a lot better than what analysts thought was going to be the case at the beginning of the quarter. And importantly, estimated revenue growth was about 1.2% out of those 85% that have reported. That's pretty good. And I think the key point is it lends credence to the idea that profit margin expansion should hold. I've talked a lot about this, that with higher energy prices, higher interest rate costs, higher labor costs, it was the consensus on Wall Street that corporate profit margins would implode this year. That has not been the case, and we're seeing more evidence of the fact that for whatever reason, maybe coming out of COVID, companies got more efficient. Maybe they were able to right-size or normalize their costs. Maybe they were harnessing artificial intelligence and driving productivity. For whatever reason, corporate America came out of that COVID period leaner and meaner, and that gives me a lot of confidence going into a potential economic slowdown because companies aren't as bloated as they were 2 or 3 years ago. Leads me to think that they might be more resilient, and then if we come out of a slowdown, whenever that is, later in 24, 25, there should be a fair amount of operating leverage. And by the way, I mentioned how yields have started to come down a bit. The 10-year Treasury, the 30-year Treasury peaked in late October, are a bit lower here in November. Also, according to Strategas, if you look at other periods of interest rate declines, those have been associated with pretty good markets. So if you go back to the late 40s, the early 50s, early 60s, mid-60s, early 70s, I mean, you look at all these periods of major rate declines. According to Strategas, the average performance for the S&P has been very good during those periods. So the most recent one they referenced was the mid-70s, where rates came down from 8.48% to 6.8% over 15 months. Stock market averaged 28% over that period. And when they looked at all the major rate declines going back to post-World War II period, the average S&P return was 17%. So, as we always say, past performance is no guarantee of future results, but I just think it's interesting that people tend to associate rate declines with risk, that the market is projecting more economic weakness. And that may be true in the short term, but if you're willing to look out 12 months or further, it's generally associated with better markets. So just keep that in mind. So remember, the premise of this podcast was let's focus on the facts, or at least the historical record, more so than what someone's spin in the media might be. Last thing I just wanted to talk about briefly, I've talked a lot about the bond market and how we're still in about almost a 40-month drawdown in bond prices, because remember, as interest rates go up, prices come down. We're in the longest bond bear market in U.S. history. Bond market has never been negative in this country 3 years in a row, and here we are in November, still slightly negative for the year. But the things could be turning a bit. And I will tell you that, again, going back about 100 years, or at least looking at the last 10 tightening campaigns by the Fed, when if you look at the period following the Fed's last rate hike, S&P has averaged about a 14% return over the following 12 months. So we don't know. We don't know if the Fed is indeed done. We don't know if we have seen the peak in interest rates, but the last couple weeks have been encouraging. And if that's the case, regardless of what happens in the next, let's say, 3 to 6 months, I expect further volatility. There is certainly reason for some optimism to hang in there, okay? And look at the next 12, 18, and 24 months if history is any guide. So just wanted to share that with you. I just want to take another few minutes here. I generally don't like to talk too much about the economy, and the reason I don't is because, as I've said multiple times, the economy is not the market, and the market is not the economy. Even if you did predict what could happen in the economy, which no one can, it doesn't necessarily be right on what happens with stocks and bonds because you don't know what was already discounted. But I still think there are a few things that are worth mentioning because we are starting to see some signs of, I don't want to say Goldilocks, but remember what the Fed's trying to do. They're trying to cool off demand, bring down inflation, but not so much that we go into a deep recession, right? So and that's what people mean when they talk about the sort of the soft landing scenario. We're starting to see some signs that, hey, maybe they could pull it off. Way too early to declare victory, right? Things could get worse, but so far you're starting to see some definite moderation in the jobs data. I mean, if you look at the most recent monthly data, the increase in total jobs was at the lowest year-over-year growth rate since the March of 2021. This is according to Charlie Bolello. You combine that fact with slower wage growth, the slowest wage growth since June of 2021, we're definitely seeing some cooling in the labor market. There's absolutely no question about it. And the U.S. unemployment rate, of course, ticked up to 3.9%, which is the highest in about a year and a half or so. All right, so we want to keep in mind, and then I'll keep that in mind, particularly the wage data, because that's a big input into inflation. The other big input into inflation that we've talked about is housing. It's almost 40% of CPI, and the owner's equivalent rent, what they call OER, you've got to remember it lags badly versus other measures of inflation, meaning we've seen rent prices coming down on a line over the last 6 or 7 months. I don't even know that's been reflected in the data yet. And as the folks up at Ritzold Asset Management noted this week, back in 2008, 2009 during the great financial crisis, owner's equivalent rent understated inflation because so many people were able to take advantage of low rates and essentially no credit standards. In this environment, they're suggesting that the lack of housing supply and increasing interest rates has overstated inflation. So if you start to see some kind of right-sizing of that data, if you will, over the next few months, I think inflation is going to come down. Whether it hits the Fed's 2% target or not, I don't know. But I think it's already down into the high threes. It's my personal belief that inflation drifts towards 3% over the next 6 months. I say this because if you listen to the debates on TV, if you listen to political rhetoric from both sides, to be honest, you would think that inflation's still at 7, 8, 9%. That is not the case, and I think it's going to come down more than a lot of the headlines suggest here over the next few months. May not be in a straight line, but it's going to come down. The other thing that you're hearing a lot about is a rise in consumer debt and increased credit losses. And it is true that consumer debt in this country, according to the New York Fed Consumer Credit Index, or credit data, is at the highest level ever recorded. But keep in mind, by far, the biggest component of that debt are mortgages, okay? And remember, I say only, but about 2/3 of Americans have a mortgage. Okay, so 1/3 of people who own homes don't have a mortgage in the first place. And out of the 60-some% that do, again, this is according to New York Fed Consumer Credit, 80%, at least 80%, are locked into 30-year fixed-rate mortgages under 5%. So yes, there's been a proliferation in debt, but it's manageable debt, okay? It's manageable debt. Credit card debt, of course, is more problematic because it's expensive as heck, right? I mean, credit card rates are in the 20s at many banks. And it has gone up. It's gone up about 4.7% in the last quarter. However, keep in mind that credit card balances are just a fraction of the actual credit card limits available. So it's not like, according to the data that I saw this week, it's only about credit card debt's at about 20% of the aggregate credit available. So it's not great for sure, but it's not like people are maxing out on their credit cards all over the place. What's more, credit card debt, according to eToro, credit card debt load as a percentage of total assets is at its lowest level in 20 years. Okay, so yes, it's gone up, but it's at a low level relative to the amount of assets that people actually have. And remember, median net worth in this country, this is almost never reported, median net worth in this country has increased 37% from 2019 through 2022. That was before this year. And remember, the stock market's up this year. Housing prices are flat to slightly up in many markets in the country this year. So net worth may even be more now. So I'm not here to tell you that everything's rosy. That's not the case. But when I hear misleading data quoted about inflation, about credit card debt and insolvency, when I hear misleading data about unemployment, really is important to filter out biases, filter out political rhetoric, again, from both sides of the aisle, and really focusing on what the actual data is and the trajectory of that data. I'm still of the opinion that the American consumer, which drives about, 70% of our economy, is in much better shape today than he or she was in 2005, 2006, ahead of the credit crisis, the great financial crisis. So I just think that the odds of a significant recession, major unemployment, major bankruptcies, major widening of credit spreads in the bond market, I just don't think that should be our base case going forward. All right, I'll leave it there. Again, the point of the first half of the podcast was to essentially be a no-spin zone and sort of look at some of the realities and the facts of the current environment, allow you to filter out some of those headlines that may be distracting. Stick with me. I just want to spend a few minutes on some of our top companies top holdings, I should say, that reported earnings over the back half of earnings reporting season. We're almost done, but I did want to share a few reports with you. Back in a second. Stocks and bonds are volatile, but your financial plan doesn't have to be. Have you sat down to map out an investment plan you can trust when emotions and headlines stir panic? I'm Simon Hamilton with the Wise Investor Show. Every week we discuss the latest financial trends and what investors need to know. To learn more about how to stay grounded and to become a better informed, wise investor, listen to the Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Group podcast. I'm Simon Hamilton, Managing Director at the Wise Investor Group of Raymond James. So Disney, Walt Disney, we all know Walt Disney. I realize it's been a controversial stock, but I did want to say a few words about their quarter. Remember that most of the stocks that we talk about are names that we own in our portfolios here at the Wise Investor Group, including Disney for a number of clients. If you are a client, I think you can be confident that we've done our due diligence as to whether it's appropriate for your particular situation. But if you're not a client, I can't manage your portfolio through the computer, of course, so please make sure you do your own homework. Make sure you understand the risks and rewards. And by the way, I own Disney as well as the other stocks I'm going to talk about today in my own portfolio. So you need to evaluate whether that constitutes any bias on my part. But yeah, so Disney reported, and as I mentioned, I totally understand it's a controversial stock. They've been highly politicized. They've gotten into a public fight with the governor of Florida, Ron DeSantis. So I understand if for whatever reason you do not feel comfortable owning Disney, but we certainly have clients that are comfortable owning it, and they are a Dow Jones component. So I think it's very important to talk about the name. And they had an encouraging quarter. If you recall, Bob Iger, who had kind of built up Disney for the most part to what it was and is, had returned to Disney and is really focused on the bottom line. I think he felt that Disney had become kind of a bloated company. Of course, Disney has really tried to make, I should say, a huge transition to developing a streaming platform that would allow them to deliver their content, which I would argue is the best in the world, through the computer in a way that becomes much more relevant in today's world, right? Disney doesn't want to rely on people going to the movie theaters or watching on TV. They want that streaming platform. But the streaming platform did not prove to be as economical as what projections were a couple years ago. It's taken a lot longer to get to profitability there. And then, of course, they're trying to decide where to spend their money. Do they continue with the TV networks? Do they put money into their parks? And so what Iger has basically done is engaged in a very significant and aggressive, some would say draconian, cost-cutting plan. And that is starting to show up in the numbers. In fact, not only did they execute on the cost-cutting initiatives that they'd already released, but he committed to another $2 billion worth of cuts in the most recent quarter, and that is starting to filter to the bottom line. They beat on the bottom line and actually raised their free cash flow estimates going forward into 2024. That was well received. They also had a much better subscriber growth, streaming subscriber growth, particularly overseas, which had been kind of a slow area for them. Seeing much better numbers overseas, much better penetration overseas, and that's where I think Disney has a real advantage over some of their competitors. They had announced previously, a couple months ago, that they're going to spend a lot more money on their parks. They really want to make parks and their cruise lines their sort of core business. That's where they're going to spend capital. And the numbers from the parks are very good. Keep in mind that a lot of people believe that the numbers at Disney parks are down. That is not the case. Revenues at the parks were up 16% year over year. So not only is the traffic still very good, but the average expenditure per person is pretty much the best it's ever been. And as far as the streaming platform goes, they still believe that they will be profitable on their streaming by the end of next year, although they did say that it won't be linear. So there was a lot to like in the Disney quarter. I think the stock is very much unloved by investors, very much unloved by Wall Street. I mean, they're trading at about the same levels as they were trading when COVID shut down all their theme parks, spring of 2020. So on a price to earnings, price to EBITDA basis, I think the stock is fairly undemanding. Doesn't mean there aren't risks. So they certainly have economic risks, right? If we go into recession and you see a pullback and people going to the theater, people going to the parks, people going to the cruise lines. So that's probably the biggest risk to the Disney story, I think, would be economic risk, recession risk. And if they do have to spend more on content to really drive continue to drive their subscriber base on streaming, obviously people aren't going to sign up for a streaming platform if there's nothing they want to watch. So if their content costs are more than we expect, that would be an additional risk. But I think if you don't have an issue with Walt Disney's sort of cultural impact in this country, I'll leave it that way. There is a compelling risk-reward at these levels. So take a look at that. I did want to mention just Apple briefly. We all know Apple, largest company in the world in terms of market capitalization. The stock, had done relatively well going into earnings. I think it was a bit of a mixed quarter, but I think there was more to like there than not. In particular, what attracted me to their numbers was the fact that their service revenues were much better than expected. So remember what Tim Cook at Apple is trying to do. He knows he's not always going to have the most innovative technology in the world, right? He knows there's not always going to be a technological upgrade that's going to get people to ditch their old phone and buy a new phone. But he also knows that people are going to have a phone. They hit 2 billion units in existence, meaning there are over 2 billion Apple products out there, unique users, I should say, of Apple products. And through those units or devices or whatever you want to call it, people are buying services, right? They're buying the App Store. They're using Apple Pay. They're using the music library, whatever it is. Those all cost money, and those service revenues were the best they've ever been. And not only the best they've ever been, but Wall Street likes predictability. Wall Street likes annuitized revenues. I think that's a big reason why Apple captures a higher multiple than it used to, 10 years ago. There was some lumpiness in their iPhone revenues. Certainly their wearables business, like the iWatch, was weaker than expected. Apple attributed a lot of that to the product launch cycle, in other words, the timing of product launches more so than actual demand slippage. On the flip side, their China business, which a lot of people have been worried about, was better than what a lot of analysts expected. So again, the risk with Apple, it's like the risk with any consumer company. If we have a recession, are people going to go out and buy a $700, $800 phone? Maybe not. We'll see. And the valuation is not cheap. Apple's up over close to 30 times earnings, which historically has been a point at which the stock has kind of paused for a while. Not necessarily sold off, but paused. So there's certainly risks to the Apple story. But again, I think there was more positive than negative in the quarter, particularly on the service side. I don't see any reason why that can't continue going into 2024. As mentioned, I own Disney and Apple in my own accounts, and we own for a number of clients as well. Just wanted to reference one other topic before I run here. There's been a lot of media, and rightly so, about Ozempic, right? It's the diabetes drug that has been kind of repurposed as a weight loss drug and is proven to be unbelievably effective, has certainly helped the stock price of Eli Lilly, who manufactures, and you could argue that that's already kind of priced into the stock, but regardless, they've had incredible growth from Ozempic. But the reason I wanted to bring it up briefly is because it has negatively impacted a ton of other stocks. So, for example, it's kind of like artificial intelligence and technology. If you don't have any association with a weight loss drug, just like if you don't have any association with AI, nobody wants your stock. It seems like all healthcare money is going towards anything to do with weight loss. So the other pharmaceuticals that maybe don't have a product in that arena have pulled back. And there may be other reasons why they've pulled back as well. But if you look at stocks like Merck or AbbVie, they have not they've had negative returns for the year, right? Seems like there's no real interest there. But the bigger issue is it's almost like the market is saying, well, nobody's going to be fat anymore. And I know I'm being very blunt when I say that. But that's kind of the way a lot of other stocks are trading. So, for example, the S&P Food and Beverage Industry Index has declined about 12%, give or take, just in the last 3 months, according to FactSet. I mean, pick your stock. Hershey's down big. Kraft Heinz is down big. Pepsi's down big. So, and this kind of stemmed from a few anecdotal reports, like from Walmart, that there's been a little bit less interest in snack food and sort of high caloric type products. So again, Wall Street's acting like the proliferation of these weight loss drug patients, if you will, is going to mean dramatically less demand for anything like snack food. And even out, you've seen the same thing with alcohol, that there's maybe less desire to drink alcohol. You've seen medical device companies come under pressure. Things like the manufacturers of insulin pumps, manufacturers of anything to do with kidney failure and heart attacks. And some of that may be valid over the next 10, 15 years. But it seems like it's a worst case scenario being priced in, right? Remember, these drugs cost up to about $10,000 a year. That's going to price much of the 100+ million people in this country who are considered obese out of that market, all right? Most people can't afford this drug. And, of course, overseas, where standards of living and annual incomes and net worths are much lower than here in the United States, it's going to even more of a pipe dream to get on these drugs. So, and there was a good article, by the way, that 100 million figure came from a Wall Street Journal article recently. I wanted to give them credit. So I think there's an actual opportunity in some of these companies that have been left for dead. I mentioned the other pharmaceutical stocks that don't make weight loss drugs, but I think in the consumer staple space, and remember, a lot of these consumer staple stocks were already under pressure, right? Because a lot of them buy them for the dividends, so they've been less competitive versus 5% cash and 5% treasuries. So the consumer staples have been under pressure for all kinds of reasons, but certainly this is another one. So I would just highlight a couple names really briefly that we own in our portfolio, that I own personally. One is Mondelez. You may not know the name Mondelez. It's MDLZ is the ticker, but they're the largest cookie, biscuit, and candy manufacturer in the world. Everything from Oreos. They took over Cadbury's a number of years ago. If you look at their numbers, I mean, they were really good in their most recent quarter. And you've started to see widening fundamental outperformance versus the other consumer staples. They beat on the bottom line. They beat on the top line. Very impressive growth overseas, particularly in Latin America. And their valuation is really not that demanding. They're actually trading at a discount to the average staple stock. So the risk there from Mondelez is probably just kind of a derating of the consumer staple space overall. Maybe staple stocks trade at a lower multiple for a period of time. But if you look at the company in isolation, I think it's very attractive. The other one I would mention, I've mentioned a lot actually over the last 6 months, is Constellation Brands, the largest importer of beer and wine in the United States, symbol STZ. They just did an investor day where they kind of outlined some of their forecasts, their own internal forecasts for the next year. A lot to like there. If you look at kind of the Achilles heel of the company, it's been their wine business. If you recall, they divested a lot of the lower margin brands to focus on premium wine brands. And that business has been kind of lackluster over the last 6 months, but they think that they'll see significant improvement on the top line and in margins over the next year. Their beer business, remember, they are the largest importer, not just of beer in general, but Mexican beers specifically, which is the number one category in this country. Modelo is now the number one beer brand in the United States. Corona is not far behind. They expect much better returns, particularly on the bottom line from their beer business than they've had in the last 3 or 4 quarters. And again, as with Mondelez, the valuation is not that demanding. They're trading less than 19 times earnings, which is not only a discount to the Staples Index, but a discount to their traditional valuation relative to the Staples Index. So I think, Constellation and Mondelez are examples of companies that may have been punished by this kind of fading of anything that maybe people won't be, quite as desirous of if they're on a weight loss drug, like snack foods and alcohol. But if you look at the actual numbers, if you look at what these two companies are saying, there is scant evidence that there's any sort of slippage in demand for their products. And the numbers kind of bear that out. So yes, there are risks to both stories, recession risks if people trade down into cheaper brands. But in terms of the actual demand for their products, in a normalized economic environment, there doesn't seem to be any significant threat from these weight loss drugs. So I just wanted to bring that up because that's been kind of the trade du jour, is to fade consumer staples, and I think it may be overdone, and I would not be surprised if staples and maybe elements of healthcare as well do better in 2024 than they did this year, especially on a relative basis. So as I said at the top, make sure you do your own homework if you're not a client. Make sure it's right for your particular set of circumstances. And every stock that I talked about today, I own on my own accounts. You need to weigh whether you think that constitutes a conflict on my part. Hope that was helpful. As always, I wish you good health and, of course, a very safe and relaxing Thanksgiving.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.